Here's a full guide to shared ownership and exactly how this works. In this video, I'm going to touch on how you can potentially get a mortgage within shared ownership where you don't need to use any deposit at all. I'm also going to walk you through what happens if you do use an element of deposit. So if you were to use a 5% or a 10% deposit, for example, how would that actually change things? I'll explain to you exactly what shared ownership is and who it might be good for. I'll also go through the criteria that's required that you need to meet to be able to use no deposit, as there's only one lender that currently does this. So it's very strict in terms of the criteria that you've got to meet. We'll run through the affordability calculator, which I'm going to get up on the screen and walk you through so you can see exactly how the numbers work and a bit of a live example for you. So, what are the pros and cons when it comes to using shared ownership? To start with, I think it's important that I say that if you can buy without shared ownership, as a bit of a hard rule, I do think it is better. The reason I say that is because the more of a property you own, the better, because then you benefit from any increases in pricing. You're also building up equity in a larger portion of the property. So if you can buy 100% of a property, I think it's a lot better. However, if you aren't able to do so, then shared ownership can be a really good option to get you onto the housing ladder, to get you into a property. And what shared ownership allows you to do, which is really interesting, is you could start with, let's say, a 25% or a 50% share, and over time you can actually scale up. So with most shared ownership properties, you can buy more and more of the property up to about 75%, and some will even allow you to buy it fully outright. So that can be really helpful for people that are struggling to get on the housing ladder to get an entrance into it. I would say the cons are, of course, you don't own the whole property, so you're not benefiting from the full amount of any increasing in pricing. You're also then paying rent on the unowned share, so you're still partly renting as well. And also, quite a lot of these properties can typically have quite a lot in service charge as well. So it there are some negatives to this. It's just if you can't get on the ladder elsewhere and you're struggling, this can be a good option, and can potentially allow you to buy a better property, for example. So just to give you an example, maybe without shared ownership, you could only afford a property up to about 175 or 200,000, but using shared ownership, it allows you to get something for, let's say, 275 or 300,000. And for some people, of course, that's very important, is to make sure that they've got enough space for their family. If they couldn't otherwise afford it, then this gets them onto the ladder with a property that they. I'll give you a brief explanation of what shared ownership actually is, and I know I've just touched on a few parts, but to really simply explain it, shared ownership means that you're buying a share of a property, and the remaining share is then normally owned by the housing association or the housing association that own the property, for example. So you would, let's say, if you buy 50% of a property and then shared ownership own the other, or the housing association, sorry, own the other 50%, it's shared ownership because you own part and the housing association own the other part. Of course, you pay rent on the unowned share, as I've already mentioned. So then you're paying mortgage, rent, and sometimes some service charges, especially if it's a flat or an apartment. These can be quite high within shared ownership properties as well. So something to look out for. Now, just to touch on the criteria that you have to meet if you'd like to use this shared ownership lender that currently does 100% LTSV mortgages, which means that they'll lend 100% of the share value. They require you to have been in the UK for 24 months. They only lend to people on skilled worker visas, health and social care visas, or ancestry visas currently. So they don't actually lend to anyone on kind of dependent or spousal visas as it stands. This might change in the future, but currently they don't. So if there's two of you, maybe you've got the skilled worker visa and your partner doesn't, unfortunately, they would only accept you and your income on the application, which can then cause some issues to do with affordability. So although this is a good step, it's a step in the right direction, no other lenders have done this yet, there is still a way to go with it, and hopefully they do end up allowing the spouse or the dependent visas onto those applications to help support the income. I know a lot of my clients, one's on a skilled worker visa, one's on a spousal or dependent visa. They still both work and they're still contributing to the household. So, of course, we'd like to be able to use that. Now, if you have a look on the screen, I'm just going to run you through a very quick example. So on the screen, I've got a couple. They've got two children. They're looking at buying a property for £300,000 within shared ownership. The first applicant has annual income of £30,000. The second applicant has annual income of £25,000. We're looking at a mortgage term of 30 years. They currently don't have any loans, or let's say they've got £2,500 credit card balance and no loans. We're looking at doing it with no deposit, and the interest rate, let's say it's roughly about 7.25%, which is just an estimation for this video. It's not an indication of what you could actually get. So if they were to buy a 50% share, so their value of the share would be 150,000 because it's 50% of the £300,000 total value of the property. We would be mortgaging 150,000. This would cause, based on that interest rate, the mortgage payment to be £1,023 per month, and then the rent on top of that would be about £344 per month. So it'd be a total payment of about £1,367 to buy 50% of the property worth 300,000. So of course it's quite high because the interest rate is high. What we could do is potentially lower it by lowering the share value. So then you're actually paying more rent and less mortgage, but because the interest rate is higher than the rent, it will balance it out a little bit. So you could start with £512 mortgage, £516 rent, which would drop that to about £1,028 per month. Something you could then look at doing is building up your equity, so either savings or overpaying the mortgage, and then in 2 years or 5 years, when you get to the end of this initial fixed rate, we could look to remortgage elsewhere, whilst, because you've built up more equity in the property, hopefully then we could get better interest rates if the market is in a position to allow us to do so. Of course, this is only half of the equation as well. It's important to mention that the other half is with the lender, so the lender still needs to deem it affordable and make sure that they're happy. So there's this check, and we have to do some other checks as well. Just to touch on what would happen if you did use some deposit. So let's say you go back to the 50% share. Let's say you were to use a 10% deposit of your share. So that's £15,000. Let's estimate that the interest rate then drops to 6.5%. So you can see here the total monthly payment drops quite considerably from where it was kind of 7.25%. You could also, in this example, so the income 1 of 30,000 and the income 2 of 25,000, potentially go for a higher purchase price. So the income. So if we go up to a £350,000 property value, you can see this is still affordable. All the metrics are fine. Of course, the payments, just to be noteful of, still increase. So that's the important thing, is making sure that the payments will still be affordable. But hopefully that gives you a rough idea of how shared ownership works. Of course, there's pros and cons to it. It's not for everyone. You can only actually access shared ownership if your household income is below about £90,000 per annum, because it's an affordable homes scheme. Can be really good to use. If you've got any questions, drop them in the comments section below. If you'd like me to touch on any more points to do with shared ownership, more than happy to do so. And yeah, thanks for watching. Just to mention, there is one other video, if you like this, that I think you'll really like in particular, and it's called Everything That You Need to Know to Buy Your First Home Here in the UK. I'm going to link it on the screen somewhere here. If you click through, it's a really good step-by-step guide of buying your first home here in the UK. So hope you enjoyed the video. Please do like and subscribe, and I'll see you in